All right. Gives me great pleasure to bring on board Prashant Jain of HDFC AMC. Yes, our viewers have been on edge that we've been teasing this interaction, and where is Prashant Jain? Well, he's ready. Finally, you can see him on the screen also. Let's start with our today's interaction with a big smile on your face. Long-term investors have nothing to complain in this kind of a market. The market and the economy surely has surprised and has stunned everybody.
Nikunj, I lost you.
Can you hear me, Mr. Jain?
Yeah, I lost you in between. Now I can hear you once again.
Wonderful. So I'm saying let's start with this interaction with a big smile. The economic recovery and the market comeback has stunned, surprised, and if I may use the underlying word, delighted everybody.
Sure, yes.
My question to you is, and this is centered around the lovely yearbook which you publish every year, the yearbook of 2021. What is your understanding of how should one read into the economic recovery? When the recovery started, everyone said, oh, it is just pent-up demand. This is revenge shopping. It is not going to sustain. But now, a pent-up demand has become structural demand. What is your view on the economy and demand for this year?
Oh, Nikunj, good morning and good morning to all your viewers. So yes, you are right. This rally has taken most by surprise. But let me just share that close to the bottom of the markets, India's market cap to GDP had fallen to as low as 50%. So I think while it is always very hard to put a number to annual returns, but I think at that point of time, it was hard to argue that markets will not do well over time. I think the economic outlook actually, if you ask me, is better post-COVID than it was pre-COVID. And the reason I say this is there are a couple of reasons. One, because of COVID and the challenging economic conditions world over, and especially outside India, the cost of capital has dropped sharply. Even it had a negative impact on the oil prices. What India needs from outside India is low interest rates, because we are a significant needs for long-term capital. And this is the best environment to build infra in India, because investors are very keen to buy very long infra assets at fairly low costs of capital. So I think that is working to our advantage. And we can see a large number of deals or assets being bought by foreign capital. The second is low oil prices. We don't know how long it stays low, but at least it has helped us in the current year. And current year, after I think 16 years, we will have a current account surplus. The third thing I think what has happened is, see, EMs are typically exporters to the developed markets. And a higher fiscal deficit and a low households leverage are both supportive of greater demand from emerging markets. So I think the external environment for India is quite conducive, and I don't think we could have asked for more. So that is one reason why I think the economic outlook has improved. Second, I think locally also interest rates are very low. You can now get a home loan at sub 7%. The affordability of homes in India is probably the best that has been experienced in a very, very long time. And that should support, that's a key tailwind for the economy. I think we have also utilized this period to carry out a number of reforms. And it has been experienced in India and outside India that most difficult reforms are typically carried out in periods of crisis. So I think even from that perspective, the outlook for economy is better. I think the most important reform to my mind, which has a near-term impact on the economy, is the intense focus on Make in India. And this PLI scheme, I think, should enable India to get a fair share of the global outsourcing opportunity in manufacturing, which we had missed last time around. And finally, of course, the base effect in 21 will work to our advantage, because simple normalization of the economy will result in significant growth over last year. So I think current year 21 we could expect a double-digit GDP growth also. Yes. Yes, Nikunj.
Could 2021 be a year when economy does well, but markets may not do well? Because markets have done extremely well in 2020 when the economy was not doing well. And you know this more than anybody else, that markets are forward-looking. So the economic recovery which you talked about, aren't markets already pricing that in?
So I would say yes and no. And you are absolutely right that markets are forward-looking. And let me just share with you where are we in terms of the markets. It is hard to give an exact outlook for 1 year returns. It's a very short-term period for equity markets. But I do feel that the cost of capital that has fallen has a greater positive impact on the markets than the impact of some loss of profits this year on the DCF values of companies. So if a company, let's say, has 10 rupees earnings per share and the price is 250, 25 times, let's say the 10 rupees earnings becomes 5 rupees in that 1 year period. So the impact on DCF is just about 2-3%. 5 rupees is the loss. But if cost of capital drops by 1 or 2%, the impact of that on the stock prices is more than the negative impact of lower profits. So I think that has to be kept in mind, that and that is one reason why markets have done well. Now, where are we today? Even at today's index levels, India's market cap to GDP is around 95 to 100% for calendar 21 or fiscal 22 GDP in our estimates. That I think is reasonable. It is neither cheap nor is it expensive, and especially given the low cost of capital. And I think we are also seeing a sharp improvement in the profitability of companies in India. And I think results have taken almost everyone by surprise. The larger companies, I think, or which could adapt to which could operate in a lockdown situation. These companies are typically larger companies, listed companies. It seems they have gained share from the unorganized sectors. And there has also been significant cost savings, and it is quite evident now. So surprise of surprises is that, and where we are also surprised compared to how we were thinking 6-9 months back, the Nifty EPS is likely to grow in the current year of all years. And profit growth has suddenly, I think the outlook has improved for the better, driven by very minimal impact on asset quality of banks, driven by higher commodity prices in metals, driven by very positive outlook for software companies, because companies have to urgently adapt to this new world, driven by lower costs across the board. So I think if you look at in sum total of this, I think markets are fairly valued in aggregate. And while I would hesitate to give you a view for 1 year, it is always extremely challenging. But I think in my judgment, if we take a medium-term view, I think equities should deliver returns that should be ahead of bonds. And the current low cost of capital, I feel, is a low hurdle rate for equities to beat. Of course, these markets are very polarized along sectors. So certain sectors are expensive, some are cheap, but that opinion would vary from investor to investor or individual to individual.
There's a lot of reference in your report to the fact that metal companies are getting pricing power back. electricity consumption is on an increase, how high frequency data points like freight has moved up. So I'm going to stick to the first part, which is commodity prices have gone higher, from cement to steel, from copper to aluminum. The first leg of appreciation is good news for companies, but have commodity prices reached a level where inflation could be a real threat, and B, it also could start having an impact on commodity consumers, which means aggregate pictures on the margin front could take a knock?
See, commodities are mainly consumed commodities are B2B businesses. So a steel company will sell to an automobile company or a construction company or a consumer durables company. And what typically happens is these companies whose inputs are commodities, they will pass it on to the end consumer. So you are right. I think the end consumer product prices should see an increase, whether it is automobiles or consumer durables. There could also be some margin pressure for 3 months, 6 months. But we have seen time and again that these costs tend to get passed on to the consumer. So I think it helps the margins of the commodity companies, but it does not meaningfully and sustainably impact the margins of the B2C companies. Now coming to inflation, I think, if commodity prices go up 1 year, that year maybe inflation is high. But if they stabilize at those levels, it does not have a sustained impact on inflation. I think inflation, which is really worrisome, is when it is due to demand exceeding supply in consumer products. And because that takes time to fix, I think, and that time will tell. But as we have said in the yearbook, I think inflation has been extremely low post GFC. And despite easy money conditions, and how inflation behaves going forward, is low inflation here to stay, or can it surprise us on the upside? I think there are different views, and we also do not have a very clear view on this. But I do feel that there is a possibility that interest rates and inflation may inch higher over time. I think in India, the outlook for interest rates is not that much as risk, because the fall at the long end in India on interest rates has been very controlled, very measured. But if you look at the rest of the world, the long end of the yield curve has fallen very sharply. So I think in India, while we feel that the short end of the yield curve should go up first, and long end outlook is one of stability for foreseeable future. But longer term, I think there is a possibility that even the long end of the yield curve could move up. Yes. Yes.
This budget, we will see emphasis on disinvestment. And you've specifically mentioned in your yearbook that the government disinvestment drive is not ad hoc now. There is a discipline and there is a thought which has come in terms of how government wants to sell. What should we expect from the disinvestment drive going forward? Because that, in a sense, is going to be a big indicator of what happens to the what happens to the PSU space.
So I think there are good developments on that front, I think, after a long time. And I think there is a definite change in the strategy that DIPAM is adopting when it comes to divesting or reducing stakes in PSUs. I think, one, the ETFs are unlikely, and the DIPAM secretary has said that a number of times. And they have also indicated that even single company OFSs that they will do, they will endeavor to maintain a reasonable gap between two offerings from the same company. I think these two address most of the concerns around divestment. And I think what they have also said very importantly is that the focus going ahead is on strategic divestment and also on asset monetization of PSUs, on healthy dividend payouts. And all of these, I think, are supportive of better valuations for PSUs. It is interesting to note, and I think we have given data in the yearbook, that the profit growth of PSUs in last 5 years is not behind the broad markets. In fact, it is ahead of broad markets. And I think, therefore, with this change in divestment strategy, hopefully things will improve for these companies. And also, I think we need to appreciate what a strategic divestment means. How is it fundamentally different from OFS? Or in a strategic divestment, there is no supply of new stock to the market, because the strategic buyer, he comes and buys the government stake, and that is followed up with a open offer as per Indian regulations. So actually, as and when strategic sales are successful, I think we can expect significant demand for these stocks at higher prices, which I think will also be supportive of this space. Yes.
You've always been a big votary of cycles, Mr. Jain, and we've looked at your presentations. I've personally followed your presentations. I've read your reports with a delight. Why is that the mean reversion is not happening this time? HDFC Bank is outperforming ICICI Bank. Asian Paints is outperforming other companies. Why is that, even though we are on the cusp of a new economic cycle, markets are still very tentative in their reorientation?
Well, Nikunj, I think you are right. And I think you were referring to value underperforming growth for a very long period. And that has happened both globally and without doubt in India as well. And it has caused pain. It has tested the patience of people who are seeking value. But I am a firm believer that, even if it takes a bit longer, the markets eventually, just like water finds its right level, markets will price assets appropriately over time. And let me give you a few examples how things have changed in the past. Well, technology was a clear consensus buy way back in 2000. An old economy no one wanted to touch, and we know what happened over the next 5-7 years. And things in technology had become expensive, even as maybe 2 or a couple of years before it finally peaked. Something similar happened in 2007, and at that point of time, it may surprise you and your viewers today, even FMCG companies were out of favor around 2007. But eventually the excesses did correct, and the space which was undervalued did much better. If you go back around 2012, 13 or 14 maybe, pharmaceuticals was expensive. I don't think it was offering value then, but it was, everyone wanted to buy. And you know what has happened in last 6-7 years, this space has sharply underperformed. So I think time and again we have seen that markets can misprice an asset for short to medium periods, and unfortunately in stock markets 1 year is a short period, and even 3 years, in my experience 4 years at time is not adequate enough. So this cycle without doubt has been a bit longer. It is the longest period of underperformance of value even globally. And I am optimistic about things changing, but as you know, it is extremely hard to time these markets. All I would say is there are certain pockets in India which are offering so much value that the dividend yields alone are more than the bond yields. And these are not companies that will not grow, that are not competitive. So I think over time, things should change. I remain optimistic on that front, yes.
IT, Mr. Jain, is a very interesting sector. A year and a half ago, IT stocks were cheap. But post-pandemic, this is one sector which has benefited disproportionately, both in terms of relevance and also in terms of dominance. What is the right way of looking at IT companies now? It's no longer value, but can you say that these are growth stocks now and we should look at them differently because of the COVID reset?
I think, Nikunj, my understanding of these companies is, I think, quite simple and fairly straightforward. This is a globally competitive sector, and what China is to manufacturing, India is to services, and we have significant strengths both due to the skilled, low-cost manpower, because of the offshore model, which drops costs very sharply, and above all, the companies which have built immense capabilities, systems, processes to handle a variety of tasks and to help their customers drop costs, cut costs. I think, but what has happened is, as your share of the global pie has grown, the growth rates have been coming down. In pre-2000s, the sector used to grow in 70-80%. It fell to 30-40% between 2000 to 2008, roughly, or around 10. Then 15-20%. In the last couple of years, this sector has been growing in mid to high single digits. So I think it is a sector that is slowly experiencing moderating growth because your market shares are pretty large and you are a fairly very large companies. Free cash flow generation is tremendous. It does not need capital. I think what COVID has done and lockdown has done, it has brought a sense of urgency amongst many businesses to adapt to the new world. And Indian companies, to their credit, they maintained seamless delivery, even in the work from home environment. When I feel some vendors who are based in US and Europe may not have done as well. And when clients are allowing you for your employees to work from home, even in an on-site situation, then what difference does it make if they work out of India? Because anyway, they are not on your premises. So I think this has also encouraged clients to increase offshoring because it drops costs. And in situations like these, when the focus is to keep the business running, when the focus is to adapt to the new world as soon as possible, the pressure on pricing is also not there. And finally, this sector has also experienced lower costs because travel costs are not there. Some other costs of when employees are working from home, it possibly leads to lower costs. And even wage inflation in this uncertain environment was not there because job mobility is severely restricted. So I think you have to see the performance of all these stocks, of these stocks in view of all these factors. Where are we today? I think my understanding is near-term outlook for growth and margins is good. But I am confused whether the sustainable growth rates over a few years, does it go up? Or is it a one-year spike in growth due to a very low base of the current year also? And will things come back to as they were pre-COVID? So I think that's a question that everyone is seeking answer to. My sense is that the growth rates that we will experience in fiscal 22 is unlikely to sustain. And over time, it being a B2B business, margins pressure could also come back because clients will inevitably push for lower pricing. And you are right, we discussed this earlier, since stocks are forward-looking, a significant part of this optimism is now priced in. And while business may do well, I think to my mind, these stocks are fairly close to fairly valued. What I mean by that, there should be some returns over medium periods, but bulk of those returns should come from earnings growth and dividends. And I think multiples are unlikely to move up in this place. Yes.
I'm going to bring, just for the benefit of our viewers, headlines which I personally feel markets have ignored. Grasim has announced a 5,000 crore capex in a cement in the paint industry. Ultratech is looking at expanding capacity. Tatas are looking at expanding capacity. Mr. Jain, good corporates who understand risk and understand how to manage leverage on their balance sheets are talking about committing to a new cycle, whether it is steel or cement, whether it is paint or even automobile, which is great news for banks. But I don't see markets reacting to it at all.
Well, I think, Nikunj, you are right. See, these are intents, and it will take time for these announcements to translate into credit growth. It will still take some time, as I think L&T chairman said last week, that he sees private capex recovery in maybe a year's time. But I think definitely now there are tangible signs of private capex improving, increasing. I think, see, what has also happened is, if you look at the current year from a bank's perspective, the credit growth has been extremely weak, because retail, which was a big driver of credit, has also suffered in this period. And there were concerns around the retail asset quality of banks and NBFCs. I think the asset quality has so far behaved not too badly. And while there is some increase in stress, I think it is quite manageable. And therefore, I do feel that over time, as this asset quality concerns wane on this space and as credit growth comes back, I think banks should do better. And I think third quarter results are extremely important. And still, I think few large banks are yet to declare their results.
Okay. I'm going to pick up something where you've really spent considerable amount of time in your report, Mr. Jain, which is the manufacturing is an idea whose time has come. And there is definitely a pent-up excitement which is there after the announcement of PLI schemes and China One policy. So from a stock market perspective, if somebody has to participate, is there a direct beneficiary, or you'll have to indirectly bet on banks and other groups only?
I think this is one theme which has a positive impact across the economy and across sectors. And now you can see clearly the intent of the government is extremely very positive. They are very focused. They are banning items that cannot be imported, that we have the capabilities to make in India. They are giving incentives for companies to put up new capacities and on incremental production. And we are also tweaking tariffs. So I think this will play out across a broad spectrum of sectors, whether it is textiles or toys or chemicals or auto ancillary parts or defense equipment. So I think it is a wide variety of sectors that should benefit from this. And I think when you invest, you create a lot of jobs. You consume more steel, more cement, more construction, more of everything. And even when these factories start producing, you again create lots of jobs, which will benefit consumption. See, last couple of years, growth in India was driven by higher household borrowings, and which were enabling consumption to grow. But that is not the best way or a sustainable way to grow, because unless you earn, you can't spend sustainably. And I think this is an extremely welcome step to my mind. Because if you revive capex, if you give protection, if local companies make money, they will invest, they will create more jobs. And that drives up consumption on a very sustained basis. And I think the reason why we could succeed this time is one, because of course of the government's intent. Also because in China, costs have been going up, as you can see in the data there. And third, the world wants to de-risk itself from over-dependence on China, because supply chain was clearly impacted due to COVID in China. And fourth, I think India has the massive advantage of a very large local market compared to other smaller Asian countries who have equally low costs but have much lower sizes of the economy. So if we use our very large local market to our advantage to incentivize setting up of capacities here, I think it is a trump card that India has. And for the first time, I think we are beginning to use it. So I feel quite optimistic that manufacturing in India will revive over time and we will increase our share. And so I think if you are a global leader in services, and if you improve your share of manufacturing, I think it augurs extremely well for faster and sustained GDP growth for next few years. Yes.
When we see what is happening in the US market because of Robinhood traders or short squeeze, when social groups are causing market movements, what does that tell you? Aren't these telltale signs that there is a bubble somewhere in making and things will fall apart, and when things will fall apart globally, we could also get hit? I mean, this is a typical behavior which is an indicator of danger, isn't it?
See, I think, let me put it this way, EMs in general and India also, which I understand well, I think I would not say there is a bubble here. And if you look at last 10 and 15-year returns of Indian markets, they are below nominal GDP growth rates. And I mean, today the 10 and 15-year returns to my mind should be between 9 to 12%, which is not pointing to any excess whatsoever. And but yes, if something cracks in the markets outside India, if there are sharp corrections, I think sharp but temporary corrections in India cannot be ruled out. In fact, we have seen that in the past. When 9/11 happened, when Lehman happened, the economy was doing pretty well, but just because the markets outside India experienced a sharp correction, we also corrected. So I don't think that can be ruled out. But I would say that such corrections provide good opportunities for the long-term investors to buy in the same assets cheaper. And every time you have invested in the past, when markets corrected driven by global events, these have proved to be great entry points into the Indian markets, but of course over a couple of years. So I would not rule out any corrections in the market. I mean, corrections are pretty normal, and it is true that outside India interest rates are extremely low. Their market cap to GDP in US is near all-time highs. So, and that is one risk we have highlighted, that if and when global markets correct, we could also experience some correction. But I think these should be short-lived. Yes.
We are talking to you exactly before the budget, so I'm tempted to go outside the yearbook and talk to you about budget. Any changes in direct taxes, do you think that could spook the market? Because frankly, if I look at the trajectory of budget and markets, the budget have got slammed with something or the other in last 3-4 budgets. First LTCG came in, then there was a taxation on dividend income above 10 lakh, then the buyback taxation was introduced, then dividend on tax also came. So from a market standpoint, how do you see budget? If there are more taxes, could that spook the sentiment?
This is extremely hard for me to guess, and you would appreciate it's very tough call for anyone to take. I mean, I would mention two things here. One, I think stability in taxation policies is in the interests of everyone, investors and businesses. And I think, so I do hope that one, we don't make frequent changes. And if there are any changes to be made, then they should be planned well, so that in the foreseeable future, you don't change these again, because that does make life difficult for investors and businesses alike. So that is point number one. We also need to appreciate that the fiscal challenges for the government were pretty severe last year. And I think it is in the long-term interest of the country that fiscal deficits are kept low, because that is what gives room for private sector to raise capital at competitive rates, and you can put the economy on a sustained growth path. So to that extent, if there are some tweaking of taxes, I think we will understand. I mean, markets will appreciate, because clearly last year was an extremely challenging year on the fiscal front. And I think, the final point I wanted to make is, while investors' attention in markets is always focused around the events and on the headlines, and that drives markets in the very short term. What I have experienced is that the correlation of medium to long-term returns in the markets is only with the valuations at the time of investment and nothing else. So I think investors should keep an eye on what are they paying for what they are buying, and if valuation is not excessive, if it is cheap, over time, I think the returns on such investments will be decent, and vice versa. And see, the interesting thing here is that valuations, when you are investing, it is in your control. But what happens in the environment tomorrow is extremely hard to both forecast, and it is not in your control. So I think I tend to focus on a value, and over time I have seen it works. Yes.
Okay, so I'm just going to wrap it up with a last point, which is for very broad audience who are investing in SIPs, who want to understand equity for long term. A lot of brokerages are saying that Indian markets are trading at 40 to 50% premium to the historical valuations. And since you have made this point explicitly that valuations is the most important entry point for future returns, what should one expect when markets are not available at throwaway price? This is not April or May levels where we were very cheap. Right now, markets have run up. We are nearing one-time market cap to GDP. What should be future returns given the interest rate and the valuation level we are at? 5 to 7 years.
See, you are absolutely right, and I reiterate that future returns are most dependent on valuations at the time of investments. But I would not entirely subscribe to that view that markets are trading at 40, 50 P multiples. See, I think what has happened is that sometimes profits do get impacted by one-offs. And so I think it makes sense to at least look at current year's earnings, because this year is clearly ending, and not look at historic P ratios, because banks were providing for NPAs till last year. Some companies had one-time write-offs, either around some asset impairments or around AGR dues, etc. So I would say at least focus on the current year. Ideally, we should be focusing on fiscal 22 and 23. And if you look at those numbers, the multiples are a lot more reasonable. The second is, if markets, even if they are 5, 10, 15% above long-term averages, I think it is okay, because one, the cost of capital, as we all know, is pretty low compared to the past. And you cannot ignore the cost of capital. And even globally, asset prices have done well. One of the key reasons is the low cost of capital. And third, the final point is the polarization or the variation in multiples across sectors in these markets is near all-time highs. And there is a very interesting chart on sectoral valuations in this yearbook. And we have also given you the standard deviation of valuations across sectors. And you will see that measure is at near all-time high. So what that means is that while the averages look fine, there are certain sectors which are extremely expensive, at least from a historical perspective, and there are certain sectors which are extremely cheap, again, at least from a past point of view. And I would suggest that if someone is uncomfortable with the very expensive valuations in certain pockets, they have the benefit in these markets of also getting some sectors at or below long-term averages and some sectors significantly below long-term averages. So I would say this market has opportunity for the significant opportunities for the value-conscious buyer. And if you are not a value-conscious buyer and if you want to invest in averages, even there I think the averages themselves don't look too unreasonable. See, let me also take a minute to give you a longer term perspective. The Sensex was 100 in 1979. And when I started my career around 91, it was around 3,000. And today it is 50,000. Now, money has become, so many times just because only if you stayed invested. And this question has been there at every level, whether the index was 3,000 or 5 or 10,000, 18,000, 20,000, 25,000. At every level, this question has been there. Is this the right time to invest? So I would say, over time, in a growing economy, what looks expensive today tends to become good value, better value over time. So I would urge investors to understand the long-term potential of Indian equities. They are compounding around nominal GDP growth rates. That should continue. And especially the low cost of capital is a hurdle that I think equities in India should be able to beat comfortably, because our growth is accelerating. Profit growth is beginning to come back strongly, and valuations are still not discounting the low cost of capital. Yes.
All right, Mr. Jain, appreciate your time. Thank you for joining us. You've detailedly outlined your thoughts and what should be the basic benchmarking for long-term investors who really are worried about the rise in the market and are worried about entry points. Appreciate your time and have a great 2021.
Thank you, Nikunj, and wish you and your viewers the same. Thank you.